What's going on, guys? It's Matthew back with another video. Before we start today, I just want to show you guys my new educational platform, the Liquid Asset Institute, where anyone can become free and become their own liquid asset. This is our Twitter account, and we also have a Instagram account. So you guys can go ahead and follow both of those socials. Links will be in the description. By the way, only use the links in the description if I ever put any links. Don't ever use any link in the comment section. Got that out the way. Next thing, we have our Telegram channel, Liquid Asset Institute. And today's video is going to be on why drawn liquidity is the most important thing in the Forex market or in any market that you trade. And we're going to be going over this case study that I sent out to the group today. Okay, got that out the way. So first things first, as we always do, before any day, we come to the, you can use any news provider, but we like to use Forex Factory as well as my FX book. But just to keep this video simple and short, Friday, May 5th, which is today, we had NFP, not for professionals, but we also did tape read it today. And I want to show you guys why I feel that the drawn liquidity is the most important thing in the markets. So let's go to the charts. Today we're going to be using MT4. I got away from TradingView. I still use it, but just because of, number one, the price of like my live account or the accounts that I'm trading on, I'm usually trading it on an MT4, not TradingView. So I need the exact prices on the MT4. And I also like how MT4 is set up, the old school way. So let's get into this video. So we're going to pay attention to this May 5th candle, NFP, 315, so bond close. So basically the daily range is already set for the day, but we're going to go into why I feel like the drawn liquidity is the most important thing in the markets. If you can take a look right here, get a little segment. I'm going to just draw out this fair value gap here. And before this candle opened, or when it opened and before it started trading, we can already come to a conclusion that price is either going to go up or down. That's obvious, but the hard part in trading is where is price going? And this is what we're speaking on today about the drawn liquidity. So anybody that's new to this channel, I'm basically going to be teaching advanced topics, and you can go to ICT's channel to learn the basics. But I'll try to throw in some basics, but you should already know all your PD arrays and the session timing. So your Asia kill zone, your London kill zone, and your New York kill zone. And if you trade London close, your London close kill zone. So it's a time and price phenomena that we speak about every day. Always starting with time. So what day is it and what time is it? And then price. Today we had a price point of this fair value gap. We were looking at this fair value gap as a drawn liquidity, meaning that when this candle opened, there was a high probability that price can go up into this area from this candle's low to this candle's high, which is a fair value gap. Yes, price could have ran lower into these lows or below this low, or even below this one. However, price traded up down into this wick, consequent encroachment, which is just the 50% of this wick yesterday. For the next day, I'm looking for a bullish candle, but obviously it's not a bullish candle right now, it's a bearish candle. But if price is going to go up into this fair value gap, we can look for an expansion, meaning that price can open, run up to this fair value gap, and either continue higher to blow out this high, or as you can see right now, reject and start going lower. But you don't need to have a, you don't need to say, okay, oh, May 5th candle is going to be a green candle, so I'm going to be a buyer. Or May 5th candle is going to be a down close candle, so I'm just going to be a seller. You need to know where price is most likely to go, and then that will be your trade for intraday. We're speaking on intraday trading. So let me drop a line segment on May 5th. Just here. Now let's go down into a 1 hour chart. We zoom a little bit closer. This is the fair value gap that we just drawed on the daily time frame. We can kind of make it look a little better, which is just this old high back here and this low. Now if I grab the 50% of this, so let's go back up to the daily. I'm sorry. If I get the 50% from this candle's low to this candle's high, grab a fib. 50% is right there. I'm going to just drop a horizontal line on that. Get rid of this fib. We have a price point of 101.479. So now let's go back to the hourly. And with the benefit of hindsight, you can see price had made a low and continued higher into that 50% level of the fair value gap. But let's frame the day. This is what you have to, this is what I like to do when I frame the day. So I have a level, that fair value gap. That's the first conclusion you have to come to after looking at the news. So I look at the news, okay, we have NFP, that's New York session. Then I come down, I go to the daily chart, I look, where's the highest probability of price going? We came to the conclusion that that fair value gap on the daily was a high probable place or price point or price to go to today during the sessions, either London or either Asia, London, New York, or London close. But if we remember, we had news in the New York session, NFP. So institutions are going to step in during that time, the New York kill zone. So there most likely is going to be a setup in that time. So it's a time and price. What time is this? What time is the setup going to form? There's NFP today, so probably the setup's going to form in the New York kill zone. Hopefully I explained that pretty good. So this is how I would frame my day. We have the 00 time, 00. That is 0 GMT. That is basically Asia's open on the FTMO server. So we like to leave that vertical line on 0 GMT, but that is not our only opening price that we like to look at. We like to look at the New York opening price as well, midnight. So on this platform, 700 is midnight. This is your Asia session. And then you have midnight. So let me draw out the midnight open. This is an up candle, so I'm grabbing the open of this candle and I'm going to draw it out. Where am I going to draw it out to? As we said, bond close ends at 3 p.m. So draw it out to 3 p.m. right now. 2200. Okay. So now I have a Asia session. Let's start it over. 0 GMT opening price, Asia session, midnight opening price, and we like to use the midnight opening price, and we also like to use the 0 GMT, but midnight is what we're paying paying attention to the most. We see a low being formed in the London session, playing off of this low to high rejection block, and price started trailing higher. Okay, now let me mark out my New York hill zone. So New York hill zone, let me change this color as well to a lighter color and get a more light gray. Okay, so 1400 is my New York open, so 7 a.m. and 1700 is the close of the New York kill zone, which is the opening of the London close kill zone. So now you have the time and play. We already had our draw on liquidity, which was the fair value gap, most important thing in the markets. And I'm going to explain why it's the most important thing. During the London kill zone, we made the low. We started to go higher. 7 a.m. up close candle. People on this up close candle would think high to low. It must be a bearish Fibonacci. So let's just draw that out. Price gets up into the 50%. People would think bearishness and sell. But the reason why the drawn liquidity is the most important thing, because once you have the drawn liquidity on the higher time frames correct, it puts you in a perspective of only looking to get in that direction. So let me say that again. If we have a bearish fair value gap, and the reason why it's a bearish fair value gap is because it was above current price during New York, the New York kill zone, because New York kill zone opened here. All right. So bearish fair value gap, for it to be bearish, it has to trade up into the fair value gap. And then as you can see with the benefit of hindsight, bearish pricing came into play. It would come back into the midnight opening price and then end at bond close. But forget all of that. If we're looking for price to go higher into the fair value gap, I would not be looking for sells during the New York kill zone. I would only be looking for bullish price action or bullish buys. So what am I looking at? I'm looking at all the down close candles, all the bullish fair value gaps, all the old highs, all the liquidity voids, bullish liquidity voids. I'm looking for all the bullish PD arrays to get me up into the fair value gap that was on the daily. We have a swing high right here, lower high, higher high, and then a lower high. So a swing high right here. And a swing high is a PD array, a premium discount array. So 7 o'clock, you see price trades higher, it closes here. I didn't get any buy signal because we want to be trading when price goes down. When 8 o'clock candle opened and it traded down into a old high, which is a PD array. Let me draw that out. I'm gonna make this color blue for buying. And I'm gonna actually change this color to the orange color. Okay, our opening price. And then the blue levels are our buying levels. So we had this old high. When 8 o'clock opens and trades down into this old high, as we said, we're only looking for bullish price action. So this right here, this is your buy. When price trades down into this old high. Make this well. This would be your buy. And with the benefit of hindsight, you see price trades down into this old high and rallies. On an M5 chart, which is our entry time frame, you will see most of the time an optimal trade entry being formed off of the H1 level that you already, came to a conclusion that, hey, that old high, that looks like an area where price can buy because it is a PD array. Go down to your either an M15 or M5. I like the M5. There's most of the time there's going to be an optimal trade entry off of the H1 level going into the daily draw on liquidity, which is the fair value gap. So with optimal trade entries, you find a swing low, which is here, right? And then you find the nearest, and then you find the swing high, it's here. And then you grab your Fibonacci, swing low, swing high. Okay. Swing low, swing high. Price trades down into optimal trade entry. And then FOMC, NFP, not for professionals, by the way. Trades down and then NFP rallies. And look where we go. When we get long here, we're not asking ourselves, oh, where can we get out or where should we get out? We already did our higher time frame due diligence, which is basically finding PD arrays and where price can go to. So before I started learning ICT concepts, I would always try to find a high and be a contrarian trader, which would be find a high and try to get a formation pattern to go lower. But now what I'm realizing is the drawn liquidity is the most important, because if I can figure out that price is most likely going to go to this daily fair value gap, that means that price is going to be bullish until it gets to that price. So if I'm going to be, that already gives me a bias for the session. Okay, I'm still bullish because this fair value gap didn't get hit. So what's my entry pattern? ICT teaches us the OTE, which is just a Fibonacci from swing low to swing high, trading down into a discounted price, which is from the 62% to the 79%. And then the MOTE that I have here, that is the 70.5, which is just half of the 62 and 79%. So boom, price trades. It's the 3 extension, 1, 2, 3, 4, get the price. And then we get a break lower. And then we get a close into the London close. So this would be your New York session. Buy, then sell it back. And then that would be a quick intraday scalp. You're done. Right? And then price trades. Break structure, another optimal trade entry. Here, after we hit the fair value gap, break structure, optimal trade entry. Back onto that, the low of the fair value gap. Boom, that's another sell. Then London close starts here. You can see just straight drop down right into the New York opening price. Bounces off of that, and now we are ranging because of bond close. But yeah, I just wanted to explain how the drawn liquidity is the most important. And no, we did not take a trade today. However, I will give you guys an example of a euro dollar trade we did take earlier this week. using the drawn liquidity. So I'm gonna just remove all of this, and we're still gonna. I'm gonna show you the dollar index first. So what day was that? That day we took it was the second. Pretty sure. Yeah, May 2nd. Let me show you the dollar index view first, and then I'll show you. You guys already seen on Euro dollar, but I'll show it again.